Do you have a game plan on when you should start receiving CPP or OAS payments? A lot of Canadians have no idea how our government pensions work until they start receiving them, and this could lead them to make very costly mistakes. After working over a decade with clients for their financial planning and seeing so many pre-retirees struggling to figure out which accounts they should withdraw from first, or the best timing to start collecting their OAS or CPP payments, here is everything you need to know about the 3 retirement benefits that you can get in Canada. And I'll also share with you some tips and considerations on how you can maximize these for your retirement. First, let's talk about CPP or Canada Pension Plan. We all know this is something that gets taken out from our paycheck, but how much do we actually pay into it, and how much can we receive for our retirement? CPP provides a taxable monthly benefit that is adjusted to inflation every year. And it was originally designed to replace 25% of your average earnings. And now with the CPP enhancement that's been phased in since 2019, it will replace 33% of your average earnings. Now, if you've retired before 2019, then the enhancement doesn't affect you at all. But if you're still working after 2019, then the enhancement will also increase your CPP benefit, depending on your contributions. But you've probably noticed by now that even with the enhancement, it's not going to be enough to fund a comfortable retirement. This is because CPP was never designed to take care of your retirement fully. It was really meant to provide a solid base for Canadians while they continue saving towards their retirement goals through personal savings or investments. That being said, the government does not want us to be poor in retirement, and that's why they made contributing into the CPP mandatory for all Canadians who work. And regardless if you're employed or if you're self-employed, you're required to contribute into your CPP up until age 65. And if you continue to work past age 65, then it becomes optional from age 65 to age 70. Now, if you're employed, then you're probably familiar with CPP being taken out from your paycheck. And your employer is also required to match your contributions as well. But if you're self-employed, then you're considered your own employer, so you actually need to contribute double the amount compared to employees. And since you don't receive a paycheck like employees, your CPP contributions are actually calculated when you file your taxes, and they must be paid before April 30th to avoid late penalties. Let's get into the actual numbers for 2025 so you have a better idea of how this works. But before we do, I want you to remember that all these numbers are adjusted annually based on inflation. So if you're looking at this video a year from now, then the numbers could look different, but the concept will remain the same. The first $3,500 of earned income is exempt from CPP, and any income you make after that will be subject to CPP contributions. And under the first earning ceiling of $71,300, the CPP contribution rate is 5.95%. The technical term for this is YMPE, or Years Maximum Pensionable Earnings. After that, any income that's earned up to the second earning ceiling of $81,200 will have a contribution rate of 4%. The technical term for this is YAMPE, and it stands for Years Additional Maximum Pensionable Earnings. So this means that once you've earned more than $81,000 in 2025, you no longer need to contribute into the CPP until the next calendar year starts. And this is why if your annual salary is higher than the YAMPE, then you notice that halfway through the year, your paycheck will actually become bigger because you've already maxed out the CPP contributions and you're no longer contributing into CPP. Now let's talk about when you can start receiving CPP. To qualify, you need to be at least 60 years old and have made at least one contribution to CPP. So even if you only worked a few years in Canada, as long as you've contributed into CPP, you'll still be eligible to receive this benefit, albeit a smaller amount. Also, something that's not as obvious is that you're not required to be living in Canada to be receiving CPP. But if you're retiring abroad and is a non-resident of Canada, then any payments you receive will be subject to withholding tax, which can range from 15 to 25% depending on your country of residence. That being said, if you plan to be a snowbird and will still be living in Canada for at least 6 months out of the year, then you can still be considered a tax resident of Canada. so you can avoid this withholding tax. Determining your residency status is more complex than what I'm outlining here, and it can have a big impact on your taxes. So be sure to consult with a professional accountant if you're not sure about this. Now, before you start worrying about the politics or how it could affect your CPP benefits in the future, you should know that the CPP funds are not managed by our government. Instead, is managed by the CPP Investment Board, which operates independently from the government. And because it's funded by employees and employers' contributions and not by government revenues, CPP is a lot safer and more solid than you might think. In fact, based on the current numbers, it's expected to be sustainable for the next 75 years. And as of March 2025, it's sitting at over $700 billion in the fund, and it has been growing at a 10-year average return of 8.3% a year. The CPP Investment Board is responsible for managing the fund and how it's being invested. So this means we don't get to choose what's being invested inside, which is awesome for those of us who would like to be hands-off with our investments. So how much can we receive from CPP then? Well, it depends on three things. Number one is how much did you put in each year? And number two is how many years did you work in Canada? And number three is when do you start taking it? For Canadians, the default retirement age is 65. And the maximum amount you could get if you start receiving at age 65 is $1,433 a month. But can you guess how many years do you have to work in Canada to receive this maximum benefit? Is it 20 years? 30 years? Surely it can't be 40 years, right? Well, the answer is 39 years. And if you're thinking, no way I'm gonna work 39 years, then you're not alone. Because the average benefit that's being paid out at age 65 is only $844 per month. This is less than 60% of the maximum benefit. And that could be for a number of reasons. It could be because you earned less than the YMPE, so you're not maxing out the contributions each year. Or it could be because you took a few years off, perhaps you went to school for an extended period of time, or it could be because you simply wanted to take a good long break. Or maybe you were working less because you had to take care of your young child. Or maybe you were unable to work due to a disability. Or maybe you immigrated to Canada later on in life, so you had less years to contribute into CPP. Or it could be because you started receiving CPP earlier than age 65. The good news is that the government took some of these into account and offers 3 dropout provisions that could help you get a higher benefit. The first is the general dropout provision. So this is something that the government applies for you automatically. And what happens is they drop out 17% of your lowest earning years from the CPP benefit calculations. For example, if you started working from age 18 all the way until age 65, then with this provision, you can drop out 17% or 8 years of the lowest earning years. And this could help with increasing your CPP benefits. The second provision is the child rearing provision. This is another provision that allows you to drop out 7 of the lowest earning years when you're a primary caregiver of a young child under age 7. But this is something you have to apply yourself manually through your My Service Canada account. Also, only one spouse can apply for this provision, so there is some planning opportunities here that could boost your family's retirement income. And lastly, there's the disability provision. And this provision allows you to exclude low earning periods due to a severe and prolonged disability. So we mentioned that you can receive your CPP benefit before age 65, but what happens to it if you choose to receive it earlier than the default age of 65? Our government does provide us with the flexibility to receive CPP as early as age 60 or as late as age 70. And receiving it earlier or later can have a huge impact on how much you actually receive. Because for every month that you take CPP earlier than age 65, you get 0.6% less each month. And that's 7.2% less for every year that you take earlier than age 65. And for every month that you take CPP later than 65, you get 0.7% more. That's 8.4% more per year that you take the CPP later. As an example, the average benefit Canadians are getting at age 65 is $845 per month. So if this is what you're getting and you decide to receive CPP at age 60, then the CPP benefit will be reduced by 36% to $540 per month. On the flip side, if you decide to delay it to age 70 before receiving CPP, then the benefit will be increased by 42% to $1,200 per month. If you want to see an estimate of how much you could receive at different ages, you could log into your Service Canada account and they will show you some estimates of how much you could receive based on how much you've contributed so far, and it also assumes that you'll continue earning your average income until CPP starts. And because of this, the closer you are to retirement, the more accurate these numbers are for you. The timing of when you start receiving CPP is a huge decision, because once you start receiving CPP, the amount is locked in for life. It doesn't go back up when you hit age 65. Not to mention that annual inflation adjustments are calculated from the base amount that you receive. But if we're strictly talking about the math, you'd be better off delaying your CPP if you expect to live longer than age 82. But life is not a spreadsheet, and sometimes what's financially optimal might not be what's best for you. Everyone's situation is unique, and there are scenarios where taking CPP earlier can make a lot of sense. So here are some questions that you should ask yourself before deciding. Number 1 is, do I need the money right now? And number 2 is, even if I need money now, do I have other sources that I can withdraw income from? And number 3 is, do I want or plan to continue working? Because if you hate your job, then that could be a huge reason why you want to take your CPP earlier. And number 4 is, how is my family health history? Because that could give you a sense of what your life expectancy is. And number 5 is, what is my retirement lifestyle going to be like? And how would it change over time? Because the first few years of retirement, you could be spending more and really enjoying your retirement. And as you get older, you start to slow down and you might be spending less over time. So that's something you need to consider in terms of what your lifestyle is going to be like and how would that change. And number 6 is, how much do I value certainty? Because getting the cash on hand and enjoying it now definitely feels more certain than a promise to get a bit more cash in a couple of years. And sometimes the best decisions in life are the ones that don't maximize your net worth. And that's why finding the right balance is really important. And in case you forgot, CPP is a taxable benefit. So you want to do some tax and retirement planning to decide what is the best timing to receive CPP for yourself. Because as we'll discuss later in this video, having too much income can also decrease your other retirement benefits. So if you're nearing retirement and you don't yet have a game plan for this, then you should definitely consult with a financial planner, because one wrong decision here can have a huge impact on your retirement. And last few things before we wrap up on CPP is the additional CPP benefits. First, there's the survivor's pension. And for this, the surviving spouse under age 65 will receive a flat rate portion plus 37.5% of the contributor's retirement pension if you're not receiving other CPP benefits. And if the surviving spouse is age 65 or older, then they'll receive 60% of the contributor's retirement pension if they're not receiving other CPP benefits. Another CPP benefit is the disability benefit. You could get up to $1,673 per month for those with severe and prolonged disability before age 65. And once you hit 65, it will automatically become regular CPP. Another one is the children benefit. So if you have children under 18 or under 25 while attending full-time school, and you either passed away or become disabled and receiving the CPP disability benefit, then you could get a flat rate benefit of $301 per month. And this is also adjusted annually for inflation. And lastly, there's the death benefit, which is a $2,500 one-time benefit to your estate. And remember, CPP is something that you have to apply for yourself. So to receive these benefits, you can either apply online via My Service Canada account, or you can do the paper application. Applying online is the preferred choice because it will be processed faster in just 28 days. However, if you go with paper application, it'll be processed within 120 days. And if you forgot to apply for your CPP for any reason, you can apply retroactively up to 12 months. On the flip side, if you already started receiving CPP but decides to change your mind, and now you want to delay your CPP instead, you can also cancel it within the first 12 months of receiving the CPP. But of course, you have to repay any benefits that you've received up to that point. The next retirement benefit you should know is the OAS, or the Old Age Security. This is a taxable monthly benefit from the government, and the amount you receive is adjusted to inflation 4 times a year. Unlike CPP, which is based on your average earnings, OAS is purely based on how long you've lived in Canada and when you want to start receiving it. This means that you can still receive OAS even if you've never worked in Canada. To be eligible for OAS, you need to be age 65 or over, be a Canadian citizen or legal resident, and have lived at least 10 years in Canada since age 18. But what if you decide to retire abroad? Well, you can still be eligible if you lived in Canada for at least 20 years since age 18, and you also have to be a Canadian citizen or legal resident on the day that you left Canada. There is some nuances here if you live in one of the 50 plus countries that have a social security agreement with Canada. And as mentioned before, if you're a non-resident of Canada, then there will be withholding tax as well. And for OAS, it's also 15 to 25% withholding tax, depending on your country of residence. Now, compared to CPP, the benefit formula for OAS is a lot simpler to understand. You can receive the maximum OAS benefit as long as you've lived 40 years in Canada since age 18. This means that if you've been living in Canada since age 25, then you would qualify for the maximum amount. But what if you immigrated in Canada later on in life? Let's say if you immigrated to Canada at age 45. This means by age 65, you would have lived 20 years in Canada. So in this case, you would qualify for 20 out of the 40 years, or it means 50% of the maximum benefit. For 2025, the maximum OAS benefit is $734 per month, and it also gets a nice 10% boost when you hit age 75. And if you're already age 75 or over, then your maximum benefit after the boost is $808. While there's no option to receive the OAS before age 65, you do have the option to delay it until age 70. And there is a benefit of delaying it as well. For every month that you delay after age 65, you will receive 0.6% more each month that you delay it by. So if you delay OAS to age 70, then your benefit could jump from 734 to 999. Do you still remember the percentage increase you get for delaying CPP? For CPP, you get a 0.7% more per month that you delay it, versus OAS, where you only get 0.6% per month that you delay it by. So there's actually a bigger benefit of delaying CPP compared to delaying OAS. This means that if you only need one of the benefits to supplement your lifestyle, you should consider taking out OAS first before taking CPP. Because by delaying to age 70, you could get 42% more in your CPP benefits, versus in OAS, you could have only gotten a 36% increase. But there is a catch to OAS, and that is if your income is too high, then you'll get hit by the OAS pension recovery tax, or more commonly known as the OAS Clawback. To understand how this works, the first thing you need to know is that the payment period for OAS is from July to June, and it's based on your previous year's income. So for example, the OAS benefits that you receive from July 2025 to June 2026 is going to be based on your income in 2024. For the benefits received between July 2025 and June 2026, the clawback begins at $91,000 and gets completely eliminated at $148,000 or $154,000 if you're over age 75. The clawback amount is 15% of the amount over the $91,000 threshold. So for example, if your 2024 income is $101,000, which means that you're $10,000 over the threshold, then the pension recovery tax is going to be 15% of the $10,000, which is $1,500. And if this happens to you, don't worry, you don't have to manually pay back the government. What happens is the CRA will automatically reduce the amount that you receive for the following year. And if you really want to get into the details, The OAS clawback specifically looks at the income on your line 23400 on your tax return. And this includes all your income from CPP payments, other pensions, RIF payments, rental income, interest income, dividend income, capital gains, and your OAS payments as well. Fortunately, most Canadians don't exceed the OAS threshold, but if you're a high income earner and have a sizable amount of assets, then this might just catch you by surprise. So what are some considerations to decide the best timing to take out OAS? Well, the same considerations with the CPP applies here. And there's one extra thing that we should consider as well. And that is your spouse eligible for the GIS allowance? Because this allowance could mean an additional $1,395 a month. And this is a tax-free benefit for your spouse between age 60 to 64. More details on this later in the video when we go over GIS. A lot of retirement planning revolves around how we can maximize OAS benefits while minimizing taxes. For example, if you're still working from age 65 to age 70, then there's a good chance your total income will exceed the OAS threshold. Then it might be obvious that you'd be better off delaying your OAS. But if you're retired, then your OAS strategy might not be as obvious. This is when you need to do more detailed planning ahead of time to control how much income you'll be receiving each year. For example, you can control how much you're receiving from your RIF versus your TFSA, because TFSA withdrawals are tax-free. So if you have some years that you're expecting higher income, then you might be better off withdrawing more from your RIF instead and save your TFSA withdrawals for later. By tweaking the amounts you withdraw from each of your income sources, you can minimize the OAS clawback and also the amount of taxes that you pay. Another thing to consider as well is pension splitting with your spouse, because you could split up to 50% of your eligible pension income with your spouse if you're over age 65. And this also allows the both of you to each claim the $2,000 pension tax credit. Or you could also consider CPP pension sharing for splitting your income. A lot of Canadians don't consider this until it's too late, because OAS starts automatically the month you turn age 65. So if this happens to you and you don't realize until you start receiving the OAS, but you want to delay it instead, then you still have a chance to do that if it's within the first 6 months of receiving OAS. You can apply to cancel the OAS, but of course you do need to repay any amounts that you received as well. That being said, don't just rely on the government to start paying you automatically, because we've also had clients who've already hit 70 years old, but they're still not receiving any OAS, even though they're eligible for it. Don't delay more than you need to, because there's zero benefit of receiving OAS later than age 70. In these cases, you can apply for retroactive payments as well, but if you're still not receiving OAS by age 71, then you're literally leaving money on the table. Finally, let's talk about the GIS, or the Guaranteed Income Supplement. This is a tax-free monthly benefit that's also part of the OAS. To be eligible for this, you must be receiving OAS, and you also need to be age 65 or older. But unlike the OAS, you have to be living in Canada to qualify for GIS. Generally, this is automatically calculated by the government to see if you're eligible based on your income. The maximum amount you could receive is $1,097. Or if you have a spouse who's already receiving OAS or the allowance, the maximum amount would be $660. Unlike the OAS, the income calculation for GIS does not include any OAS payments that you receive, but it will include all other income, including your CPP. You do need to have little to no income aside from OAS to qualify for the GIS, and it gets eliminated completely if your income is over $22,000 as a single, or if you have a spouse, then it will be different income thresholds depending on your situation. And if you do qualify, then the GIS payment will be sent along with your OAS payment as a single payment. Lastly, let's talk about the allowance amount that we've been mentioning throughout the video. The allowance is a tax-free benefit you could get under the GIS program if you're age 60 to 64, and you're currently living in Canada, and your spouse is eligible for GIS. Your combined annual income also needs to be below the income threshold of $41,000. For 2025, the maximum allowance you could get is $1,395, but it is ultimately based on your previous year's income. And if you're eligible, then you should apply for this 6 to 11 months before you turn age 60. And you can also do this through the My Service Canada account. There's also an allowance for survivors. And to qualify for this, you need to be age 60 to 64, and you're currently living in Canada, and your spouse has died, and you have not remarried. And lastly, your income needs to be below the threshold of $30,000. The maximum allowance you could get as a survivor is $1,663, and the amount you receive is also based on your previous year's income. Now that you know how much you could potentially receive from our government pensions, you might just realize that these alone is not going to be enough to fund a comfortable retirement. Click here to get a better idea on when you should retire and how much more you need to be financially ready for retirement.